It's Brian Preston, the Money Guy.
Caitlin has a question. She says, we are in our early 30s and we are debt-free besides our mortgage. We are looking at investing our extra mortgage payment instead of paying it towards our principal. Is this the best plan?
So let me. I don't know if I caught all that. So debt free except for the mortgage.
Mm-hmm.
Yes.
All they have is a mortgage. They're making an extra mortgage payment. You hear about this trick. You make one extra mortgage payment, or you pay bi-weekly. You get extra mortgage payment in there. And she said, "Hey, I'm in my early 30s. Is that the best thing to do? Or instead of paying extra on the mortgage, should we be investing?"
I'll let you go first because maybe she can also drop in and we can get this up. What the interest rate? They share the interest rate? Because interest rates are getting a little more complicated these days.
Investing, next question. I'm just kidding. I'm totally kidding. Here's the thing. In your early 30s, your dollars are so powerful. We talk about it all the time. Go download our deliverable, moneyguide.com/resources. Every dollar that you deploy can multiply many times over, 20 plus times over likely by the time you get to retirement. Well, when you prepay the mortgage, we love the idea of you being debt-free. We love people actually being debt-free when they get to financial independence. But every dollar that you apply to the mortgage is really just saving you the interest rate. And you make a great point. Maybe it's a 2.5%, maybe it's a 5.5%. Even if it's something higher, like 5.5% or 6%, relative to the compound interest that you can earn on your investments, it's really hard mathematically to make the argument that it's more advantageous to prepay the mortgage than to be building those dollars. Now, don't want to steal Brian's thunder. He's going to say, I'm going to steal his thunder anyways. If you're saving 25% and you're doing all the things you're supposed to be doing, then it comes down to your why. What are your goals? And I would agree with that full fold. If your goal is to be debt-free, then you use your money to accomplish that goal, assuming that you've checked all the other boxes and you're not trading short-term security in exchange for long-term security. That's not a good trade-off. You would much rather have your dollars working so that over the long term you build enough wealth than just paying off the debt in the short term, and then you get to financial independence and you don't have enough juice in the system working for you.
Yeah, here's the decision matrix. You're in your 30s, you said, so make sure first you're actually saving and then investing 25% of your gross income. Yeah, that's a Bo Hansen echo from what he just said. How close are you to age 45? Why do I throw out the age 45? There's a reason we do this in our decision matrix. Is because of exactly what Bo was sharing. A 30-year-old has a chance for their money to multiply by 23-fold. $1 can turn into $23 at retirement. A 40-year-old, it's $7. A 50-year-old, it's $3. So, you can see by the time you're 45, your money just doesn't have as much opportunity to grow. So your biggest concern when you're under 45 is, am I taking and investing enough? Because the risk is, I won't be successful and financially independent when I'm older. Post 45, your risk is, why should I have debt? Because hopefully you've made all the decisions when you're younger so that your money's working for you and you're just trying to take more risk off the table. But your risk when you're in your 30s is you're going to get to be older, 45 and 50, and not have enough money working for you that you no longer can replace it with your back, your brains, and your hands. So that's why I love the thought of make sure that you are maximizing the growth opportunity when you're under 45. And then the last thing is exactly what Bo was talking about, why. So go through that decision matrix. 25% gross income has to be invested. Where are you at on your journey to age 45? So you're making sure you're maximizing the growth building when you're under 45, maximizing the risk reduction post 45, and then make sure it all ties into your why, because that's going to help you stick the landing on when you actually need to live off the money.